My friends, most people are buying and selling stocks the wrong way.
I've lost everything!
There's a way that you guys can be buying and selling stocks where you actually set the price you want to buy or sell the stock at, and you will get paid in cash until that stock hits your desired price. In this video, I'm going to show you a really basic option strategy that will allow you to generate some extra income on top of your already existing investing strategy by using naked puts and covered calls to enter and exit your stock positions. So let's first explore how most people buy and sell stocks when they first get into investing. So when I first got into investing, like many other people, I pretty much thought it was just buying and selling shares of stock. So like most people, I would just go in, and if I wanted, 5 shares of the S&P 500, I would just type in 5 shares and give it to me, and it would go at the market price, right? You don't want to be setting these types of orders up. At the very least, you want to be setting stop limit orders. Stop limit orders are going to allow you to just set the price that you want to buy or sell at. So you have a little bit more control over what the price is actually going to be. And this isn't as big of an issue in really liquid markets like the stock market. But as a good rule of thumb, you should be setting stop limit orders and not just naked market orders. So I used to think I was really smart doing this, right? I would go in and say, okay, not only do I want to buy some shares, but I'm going to sit there for, I would literally sit there for 5-6 hours, guys, and say, okay, I'm going to it's at $339.63 right now. I'm going to save 13 cents a share, right? And I would go buy my shares and think I was all cool. This is really just a waste of time. This is you spending all of your productive energy sitting there watching little numbers go up and down and trying to time the market to save a few pennies. Really bad investment strategy. And this is how I bought and sold stocks for many, many years, until eventually I figured out how the big boys get into and out of stock positions.
I got big boy pants on!
And that's using options contracts. And guys, this is a good time to mention our disclaimer. I am not a financial expert. I do not have any degrees that qualify me for this officially. I am a high school dropout. I don't even have a high school diploma. So I am just some guy on the internet talking about investing. Use this as an educational concept, right? Use this strategy and maybe implement it into your investment strategies. But this is here for your education and for you to see how my personal investment strategies have evolved over the years. And hopefully that can help you out as well. So guys, the options market is super, super complex, and there's a lot going on there, and I am certainly not an expert there, but we're going to be talking about 2 very simple options trades here today.
Thank you, Jesus!
One is a naked put, and the other is a covered call. But before we get into all of that, let's make sure we just understand what an option is. Options are just contracts that give you the right to buy or sell something at a certain price during a certain time period. Options that give you the right to buy something are called calls, and options that give you the right to sell something are called puts. Every options contract is going to be made up of a few simple elements. You have the actual type of option. Is it a put or a call contract? And a good way to think about this is a call option gives you the option to call that asset, in our case stocks, to call those stocks to your stock account. Whereas a put option gives you the option to put your shares onto someone else. So a call allows you to buy something, a put allows you to sell something, and you're not obligated to, but you have the option to.
Oh, I get it!
The other pieces of a options contract are going to be the actual underlying asset. So what do we actually have the ability to buy or sell? You have your strike price, which is essentially the price that you are able to buy or sell that asset at. You have the expiration date, which is how long, what is the time period or the deadline for this person to actually exercise this option. And exercising an option just means that one party has decided to actually execute the contract and go through with the transaction. If someone decides not to execute the option before that expiration date, then the option just expires and nothing happens. The one last piece of an options contract that makes this really interesting for us is the premium. Every options contract is going to have a premium attached to it because no one's just going to sign an option away for free.
No, 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 hell no!
So I know this all sounds really complicated if you've never heard about options before. Let me give you a real-world example that simplifies this entire thing. So imagine that you and I enter into a contract that gives me the ability to buy your house anytime in the next year for $500,000. This option is obviously worth something because at any point in the next year, if your house went to, say, $550,000 in value, I could force you to sell that house to me for $500,000 and keep the $50,000 profit. So you would be dumb to sign this options contract for free, but I might be able to pay you like $50,000 to sign it. So in this hypothetical situation, I am buying a call option on your house. That's the underlying asset. The strike price is $500,000. That's the price that I can buy that asset at. The expiration date is any time in the next year I can force you to go through with this transaction. And the premium, the actual cash payment that you're going to take for signing this contract is $50,000 cash today. So that's just a really basic rundown of how an options contract works and where the value comes from. The value of options contract is very much speculative. Now, guys, if this all just sounds way too complex to you, don't jump into the options market before you have a decent handle on it. There's a lot of good free training resources. I'll link to some of them below, but there's a lot of courses out there for you to figure out how the options market works and how to navigate the market. What we're doing here is one of the least risky things you can do in the options market. So you got to be careful. I don't do much with options outside of this, so just keep that all in mind. But for those of you still keeping up, let's go one step further and make this a little bit more complex and talk about naked puts and covered calls. So you already know what a call and a put option are. So what makes a put or a call naked or covered? Naked in the investment world just means that you do not own the underlying asset, whereas covered means you do own the underlying asset. So what we're going to do is write put contracts and give other people the option to put their shares of stock onto us at the price that we want to buy at. Doing this is going to allow you to get into your stocks at the actual desired price you want to be in at.
That's awesome.
And you will get paid a cash premium until the stock hits that level and you actually get your shares. So let me show you an example on Robinhood here and we'll show you how this is done. So let's say I wanted to get into the S&P 500, since that's the example we're using here. Yes, you could just go buy the shares. You could even do a stop limit order and, feel like you're getting a great price. But the way the big boys do this is they just get in and out in the options market, right? So maybe I will just go sell a put, right? I don't have the 100 shares that are the underlying asset of this contract. So by me selling a naked put like this, because I don't have that underlying asset, it's naked. By selling a naked put, I'm basically hoping that the price goes down to the level I want it at. And when it goes down to that level, I'll take the shares then. Until then, I want to be paid to not own this stock. So let's say I want to get into the S&P at 335. Well, I will just sell a naked put contract here, and it looks like I can get at least 71 cents right now. So what this literally means is if the SPY drops to 335 or lower per share before or on August 26th, then I will more than likely get my 100 shares at that price. But you know what? I'm also going to keep the $71 I got for writing the contract, right? So now you're actually able to generate a cash income on top of your current investment thesis. And as you're getting into and out of your stock positions, you will get paid until those stocks hit the level that you want. Now, the one caveat here is you have to make sure that you're doing this with stocks that you want to own for the long run. Eventually, we are going to get assigned our 100 shares per options contract, so you have to be comfortable owning those shares.
I like it a lot.
But there's so many benefits to getting into a position like this. In my experience, it just forces you to actually look at the company financials and set a reasonable price that you think the stock should be going at. And I just feel like it really helps me to avoid the hysteria and really get into the books of these companies and analyze your investments with so much more due diligence when you're buying them and selling them in this sort of way. But until you get assigned those 100 shares, you just keep writing these put contracts over and over and getting paid a cash premium until that stock drops. So let me show you a real world example so you can see just how this works. So I really like the company Slack. We use them in all of our companies, and I've really liked them since they IPO'd. So when they first went public, I said, man, I really want to get into Slack. Let's, see what they're worth, see what their revenue, their profits like, and their growth and everything. When I first got into Slack, it's not like I just went in and started buying and selling shares, right? I started writing put contracts. So here's a $45 credit for a put, $20 strike price, 11/15/19 was the expiration date. And as you can see, that expired worthless because Slack was still at $22.86. I didn't want to buy Slack at $22.86. I wanted to buy them at $20.
It's just 25 cents.
Hey, listen, guy, he doesn't want it.
So it wasn't a huge credit, but again, that's like 45 bucks in my pocket. I got paid for not owning Slack. Here is and as you can see, I will start to move the put and call prices, the strike prices. I'll start to move those around depending on how confident I am in the investment, if I want to get in or out of something, if I want to go heavier or, get out of a position. So this is a put option, $20.50 strike price, 11/22/19. Only got a $20 credit for this one because I was trying to buy this stock. Sometimes you just want to buy the stock, right? And the stock did not go down enough and it expired worthless again. So then I said, all right, I'm going to start doing some higher priced puts, right? I'm going to get a bigger credit because it's going to be more likely that I actually get this assigned. So here's a $110 credit, $21 put, 12/6/19, and this one actually expired worthless as well. Finally, I get assigned something here. Here's a $22 put, 12/13/19, and on 12/13/19, Slack was under $22. So I finally got assigned my 100 shares of Slack. I had to pay my $2,200 of collateral out to cover that naked put. Once you finally get assigned those 100 shares of the stock, even if you want to hold this thing for a long period of time, you can start to execute our second income generating strategy here, which is covered calls. With covered calls, you are going to be writing contracts, but instead of writing a put contract where you're going to get the stock put on you, you're going to write call contracts where someone else will be able to call your 100 shares away from you if it hits that strike price. Of course, we're going to be collecting a cash premium for every single covered call that we write. So let's jump into Robinhood again, and we'll take a look at the SPY once again. So let's say I got my 100 shares of SPY, and now I want to start generating some extra income on top of the appreciation I'm expecting. So what I might do is go into, there's tons of different expiration dates you can scroll through up here. I usually do pretty short-dated covered calls if I want to hold the stock for a long period of time. And what you have to keep in mind is, if I am selling a call option at 340. If the price of the SPY goes over 340 at all before 828, I am going to lose my 100 shares. So you just have to keep in mind that you might actually lose your shares here, and you want to kind of gauge that. And again, this is where it forces you to actually give your own valuation to these companies and to your investments and just have a much longer time horizon with your investing in general. So let's get back into this one here. And let's say I got my 100 shares at $3.35 a share, and I want to hold this for a long period of time. So I don't want to sell a covered call really close to the share price, but I would be perfectly happy selling a covered call at, $3.48, let's say. I think it's really unlikely that within the next 7 days or 6 days, the SPY is going to jump above 348. So maybe I am perfectly fine taking that risk, and it's not going to be a huge premium that I get here, but it's still going to be $12 that I can take and eventually buy more stocks. So this is such a great way. If you take this additional income that you're generating and just start to compound it with all your other investments, this is a really, really powerful strategy to deploy. So I would sell this covered call here. And guys, if I ever want to get out of a stock position, I will say, okay, I think that the SPY is overvalued at 340, and I will go sell a covered call at 340, and I will actually hope that it gets executed and assigned, right? And I lose my 100 shares. But I am going to not only get my price of the 100 shares, but I'm also going to get the $221 credit on top of it. So you can see here, even if I wanted to sell the SPY at the price it's at right now, why would I go in and just sell 100 shares when I could just sell a covered call and get a $280 credit on top of selling the stock, right? So now I'm going to go in and start selling covered calls on my 100 shares. So here's a 2250 call, 12/2019, $16 credit, expired worthless. Here is a $24 call, 110 expiration date, $33 credit, expired worthless. Here's a $24 call, 214, got a $45 credit, worthless. So you see how this is how the big boys get into and out of major positions. You don't want to be buying and selling stock on the open market, and really you don't even want to be pinching pennies with stop limit orders. You want to set your own valuations, your own desired buy and sell prices, and then use naked puts and covered calls to actually execute and get into and out of those positions. So guys, hopefully this helps you a lot, because this really not only helped me in generating more income and stronger investment returns, but it also helped me in just understanding the options market. I think this is a great way to get into options, because the options market and the derivative markets in general are really interesting, and there's a lot of powerful things you can learn there, but it's super, super risky. So you got to be unbelievably careful, and naked puts and covered calls are just about the least risky way to get into the derivative market and start to get some experience with it. So it really helped me out, guys. Hopefully this strategy helps you out a lot as well. If you guys like the video, give us a like, subscribe, questions below. We're always answering down there, and we'll see you in the next one, guys. Hopefully this helps.